Hi, welcome back to another edition of Lipper's Fun Flows Insight. My name is Tom Rosine. I'm going to be reporting flows for the weekend of Wednesday, December 16th, 2015. Now, I'll be reporting this via webcam rather than our traditional studios. Broke my ankle playing hockey several weeks ago, and while I'm in a walking cast, it's on my right foot and I can't drive. But today I wanted to talk to you about the flows because they were so big, we thought this is a very important message to get out. $42 billion left the conventional fund business, and we have some ideas on why that might be, and we thought we'd share that with you today as well. Now, this was during a period of time, basically, where we've seen some bipolar behavior by investors. First couple days of the week, we saw that oil tanked, and with that, the market tanked. A couple of days into the trading week, we saw that oil recovered, and markets recovered with that, and they continue to recover, even though we saw a little dip in oil on Wednesday after the Fed came out and basically finally raised interest rates. They raised interest rates for the first time in almost 10 years, and I think investors breathed a sigh of relief because the Fed came out and not only raised interest rates, they finally pulled the trigger, but they basically said we're going to take a slow and steady approach. It's not because we're worried about imminent inflation. It's just that we have to start normalizing these interest rates again. And they were very adamant about that point. But the reason we saw these large outflows, I have two hypotheses on this. Basically, we have TNAs being reported on a weekly basis to us on a Wednesday basis, and that's how we calculate estimated net flows. Well, during December, we have funds, most equity funds pay out their distributions in December. So if a fund goes ex-dividend on a Wednesday, the amount of that distribution is actually taken out of the TNA as they pay investors. Well, most investors, probably 90% or even greater, reinvest those distributions back into the fund. Well, they get the NAV that evening, and then next day we'll see them show up in that TNA. So this might be a transitory, temporary effect that we're actually seeing initially. Also, as one would expect ahead of tax season, a lot of people are doing tax loss harvesting. Well, when I did a deeper dive into this, I saw that of the 7 largest outflows since 1992 on a weekly basis, 6 of them occurred in December. So this is certainly a story we wanted to get out and let people know that maybe it's not as bad as we think. Sure, people are bailing, but there might be some obvious reasons. Again, TNAs might be reversed in a week or two, and certainly in January, people are trying to avoid wash sales. We might see them actually reinvest these monies back in January when they can maybe make some good buys after the market's gotten tipped a little bit. Even though some people are calling for a Santa Claus rally to actually occur in this latter portion of 2015. Well, let's go ahead and take a look now, though, at the macro groups to see where, in fact, the money went and how deep and how bad it was. Equity funds saw the largest outflow, $17.3 billion, and this is one of the third largest outflows that we have seen on record. Taxable bond funds, $13.7 billion outflow. This is actually a record since 1992 as far as weekly outflows go. But the shiny kind of spot, it was municipal bond funds, of course, ahead of tax season. Third consecutive week that we've seen inflows. 11th consecutive week that we've seen inflows. This time to the tune of about $300 million. And of course, we take a look at the money market funds. They actually took a bath as well, losing about $11.3 billion during the week. Well, why don't we take a deeper dive into the each individual macro group to get an idea on how this actually occurred. If we take a look at equity funds, we saw that they actually had plus side returns from a Wednesday point, 0.53% return. That percentage change market on this slide gives us that information. But we saw that for the 6th consecutive week that we've seen outflows, this time to the tune of $17.3 billion. How that broke out, though, is we take a look at domestic equity funds. They lost about $12.5 billion, while non-domestic equity funds, so about $4.8 billion, leave their coffers. Large cap and small caps were the big pariah on the domestic side, $9.7 billion in outflows for large cap funds, $3.7 billion in outflows for small cap funds. And then if we take a look at the kind of the international side, we saw that international equity funds lost a ton as well. $4.7 billion in emerging market funds. They only saw about $1.4 billion in outflows. Now, true to heart is what we've been seeing over the last several weeks, maybe even months, is that authorized participants or the institutional investors creating and destroying ETFs actually were made a different play. They actually were net purchasers this week of equity funds to the tune of $4.1 billion. And this is the 10th consecutive week that we've seen inflows into this group. Now, the top attractor of assets for the ETF universe was kind of in a non-traditional area. If we take a look at that, basically we saw the Energy Select Sector ETF taking about $1.3 billion, and the iShares MSCI EFA taking about $1.1 billion, while SPY, the S&P, the Spider S&P 500 ETF, losing about $800 million, and the Wisdom Tree Japan hedged equity fund losing about $522 million. So certainly there was a tale of two cities when we take a look at the retail investor behavior and the institutional investors or authorized participants. I don't believe authorized participants are that concerned about tax loss harvesting, and that's why we might see them take a counter indicated type of approach than the retail investors. They're actually building inventory for us to buy when we come back to the markets here shortly, or if we do get a Santa Claus rally being created. Well, let's go ahead and take a look at the fixed income universe, because that's certainly a different story as well. Now, normally when we take a look at the fixed income universe, we actually see a dichotomy between them, between retail investors and the ETF investors, and that is not the case this time. Again, as I told you, we saw some pretty big outflows. It's the sixth consecutive week we've seen outflows, this time to the tune of $13.7 million, by far the largest outflow seen on a weekly basis from the taxable bond fund side since we started collecting and actually calculating estimated flows in 1992. So that was a huge piece. It is the second consecutive week that we've actually seen negative performance, this time to the tune of 0.40 negative percent return. So that wasn't even that big. But if we take a look at kind of who suffered the most, flexible funds basically saw $5.1 billion, fifth consecutive week that they've actually seen outflows. And when we're taking a look at that as well, we took a look at corporate investment grade debt funds, and they lost about $4.8 billion. So certainly the outflows were very, very dominant on the fixed income side. It makes sense to us as investors wanted to get out of the way of the Fed raising interest rates, and I think that was one of the major causes. And there might be some tax loss harvesting there as well. I don't think that's as big of an event on the fixed income side, but certainly there could have been some of those, take the gains right now, worry about those losses, and maybe reinvest at higher interest rate later on. And that's certainly what maybe got investors going. Now, as I said, if we take a look at the fixed income side on the ETF universe, basically the same thing occurred. We saw about $1.7 billion exit their coffers. It's the third consecutive week we've seen outflows from this group. At the top of the inflows group, we saw the Spider Barclays intermediate term treasuries. Kind of makes sense, I guess. When you have raising interest rates, even though it's on the treasuries that they're raising interest rates, it's usually at the very, very, very short end of the curve. And so maybe they were getting ahead of this, saying, hey, listen, people are going to want to flock back into treasuries, especially intermediates. This is where they'll get the biggest bang for their buck. That's not necessarily true, but again, this is what we saw. What surprised me is seeing the iShares at 1 to 3 year treasury bond actually take in money. That would be an area I would have thought actually lost. But really, I think this is a risk-off play again, where if we look at the bottom, iShares, iBox, high yield corporate bond fund, basically saw the largest outflows, and that basically was to the tune of $768 million. And it's certainly something that we'll be keeping an eye on as well to see if there might be a little reversal there as investors jump back in the market if they think there is good growth. Because if there's going to be good growth and the economy is tooling along like the Fed basically said that they were supporting, there might be ideas that corporate investment grade debt funds and maybe even high yield funds, even though we've had a meltdown in the Third Avenue Fund, maybe the high yield funds might be a place that investors could actually still get some money in return, especially if the market starts tooling ahead and doing better, doing a little bit stronger. There'll be less likelihood of, let's say, bankruptcies and the like. And so maybe there'll be a kind of a more popular group. But let's take a look now at our muni bond fund category, the only shining piece in this whole report this week. Basically, muni bond funds took in $308 million, and this is the 11th consecutive week that they've seen inflows, and this makes total sense ahead of tax season. Investors certainly are worried about Uncle Sam taking their money, so in the latter portion of December, we do see an increase in municipal bond funds, taking in money and the like. Basically, the second consecutive week, though, we've seen negative returns again. I think this might be related to the Fed raising interest rates, this time to the tune of only 0.06% as far as losses go. And if we take a look at national ratings, we see that 291 million came into the national munis, and so a little bit on the single state side as well. And again, this is the 11th consecutive week that we've seen national munis actually on the plus side. Again, over the last several weeks, we've actually seen single states actually taking it on the chin and having some of the money get handed back. And I think investors, again, are looking for individual state risk in that case, and preferring to at least avoid federal taxation, maybe avoid the state if they think there's too much risk on that portfolio. Well, let's take a look at money market funds. They actually saw some big outflows as well. Certainly not a record by far. We can see on November 18th there was a larger outflow than that, but $11.3 billion in outflow, even though it's the first week in 4 that we've seen outflows. It certainly was part of the story. And how this broke out, if we took a look at taxable money market funds, they saw $14 billion in outflows, while tax-exempt money market funds, again, people getting concerned about Uncle Sam taking their money, they saw about $2.7 billion in inflows. Now, one of the stories, though, we always take a look at is, what happened to institutional, what happened to retail. And basically, the institutional money market funds saw about $18.3 billion in outflows, while, again, the retail investor who had a flight of capital, who was kind of getting out of the way, uncertain about the news, saw $4.3 billion of net inflows coming into the coffers. So certainly that was a little bit of a change of pace, where we're seeing the retail investor actually putting money in that kind of safe place, and not just putting money under the mattress or into equities or fixed income, actually using their money kind of in a more constructive manner. Well, if you want to do a deeper dive into the flows this week, you can certainly go to our site at www.lipperusfundflows.com. If not, you can join one of our analysts next week when they talk about flows. In fact, that is not correct. Actually, we will be discontinuing the flows for the next 2 weeks. Our next one will be actually on January, for the weekend of January 6th. That's a Wednesday, so you'll be having this video on January 8th. But until that time, basically, you will be able to go to our site and take a look at some of the updates. We will have updates on that. We just won't be writing any reports on it because of holidays and vacations that we will be taking. So we wish all of you a very happy holidays and a great new year, and we'll see you again on January 8th, reporting flows for January 6th. Thanks for joining me today. My name is Tom Rosine, wishing you the best in your wealth planning and creation.